Well, welcome everybody. Excited to be here for our Virtual Connections webinar series for the Global Consortium of Entrepreneurship Centers. Today, we're going to talk about student-led venture funds. But first of all, a quick commercial for GCEC. If you don't know our organization already, then welcome. We have an amazing community of entrepreneurship center directors, people from all over the world who run their different entrepreneurship programs in different ways at different universities. We come together to share best practices, learn from one another, monthly webinars, an annual conference coming up really soon in Las Vegas. And we welcome you to become a part of our community. So once again, a quick plug for the conference. The early bird registration ends today. So if you haven't signed up yet, maybe now is your incentive to do so right away. I know I've got my hotel booked, I got my flights booked, and I'm really excited about gathering with our community. So come on out to Vegas at the end of October. So my name is Jeff Reed. I'm the founding director of the Georgetown Entrepreneurship Initiative. And we have three amazing colleagues here today who are each going to share their experience about running a student run or other similar kind of venture fund. We'll have a chance to ask them some questions. I encourage everyone in our audience to ask questions throughout using the chat function. And I'll note that the session is being recorded and the slides are going to be available on the GCEC website afterwards. All right. So you can see here, our panel consists of Elaine Hagan from UCLA, Eric Gordon from the University of Michigan, and Leith Martin from UNLV. And I think we have chosen Leith to go first. So I'm going to turn it over to Leith and let him give you an overview of what's going on at UNLV.
Thanks, Jeff. So what I thought I would do, considering our audience, I assume the vast majority of members of our audience are individuals who are considering a student fund. So what I thought I'd do is give you some historical context on how we set up what's called the Rebel Venture Fund at UNLV. It's locally known as RVF, meaning the local investment community call it RVF. Our fund was seeded with a $500,000 gift from a local individual who was an active angel investor and thought it would be important for students to understand certain aspects of angel investing and might be able to learn about entrepreneurship in general through the investing process. And so I think one of the most important things to consider when thinking about setting up a student fund is determining specifically what your goals are. And that sounds pretty elementary, but the truth is the goal of the fund to make money, or is the goal of the fund for student experience? Is the goal of the fund multiple of those things? Because the reality is sometimes those two things don't align. So for example, our fund was set up over 10 years ago, and the primary purpose of the fund was for students to have the opportunity to have experiences that would be more difficult for them to have in the classroom. And that was the number one reason for the fund. The number two reason was that there was a hope that the student investments would be successful enough that they would perpetuate themselves, right? So it would become an evergreen fund, and they continue to make investments out of that original seed investment or seed gift of $500,000. And then the third goal was, in the event that they made a great investment, a company did extremely well, the university would ultimately benefit. As some of you may wonder, logistics on how to set up funds like this in terms of integration within a university environment sometimes can be difficult administratively. For example, in the state of Nevada, it is actually against the state constitution for the university itself to hold equity in privately held firms. And so that obviously is a pretty significant hurdle if you're going to invest in startups. And so we do have an external organization, which many universities have, that manage what's called non-core assets. So for example, we have a technology park that collects rent from companies that are inside the technology park. And that technology park is managed by something called the UNLV Research Foundation, which is external to the university. And so when we make an investment in a company through a convertible note or equity, the note is actually held externally outside the university via this research foundation. The students can participate from all parts of campus. We have engineering students, we have law school students, we have med students, we have business school students, we have some MBAs, some undergrads, we have freshmen, we have grad students, we have all different types of students who participate in this particular process. In terms of regional focus, every group of leadership that comes in and runs the fund has a different focus. It's interesting how that works, right? So a group of student leaders will come in and they may be in the leadership role for somewhere between 12, 18, 24 months, depending on the graduation schedule. And they change the focus sometimes. So sometimes they say, we want to focus regionally on companies that benefit the region. Sometimes the leadership group focuses more nationally. And we source deals through things like the Angel Syndication Network, other angel groups in the region. They actually take a considerable amount of local deal flow and regional deal flow through their own website. You can learn about the Rebel Venture Fund through our website. It's rebelventurefund.com. And when I say the students run the fund, they run the fund. I don't attend their meetings. They meet every week. When they decide or to give a board update, we have a group of advisory board members and management board members. And 2 or 3 times a semester, the students call the board meeting. And in that board meeting, they provide updates on specifics, what the membership looks like, what the deal flow looks like. If they have a deal they want to present to the board, they do it at that time. They might pull board members in during the due diligence process to help support them in ways that they might not know something about a particular industry. And that those meetings are held at our incubator, which is in a Class A office space off campus. And we have board members attend those as well as all of our students. It's interesting. I mentioned earlier that this fund was originally set up specifically to allow students to participate in experiences that they might not get through a class environment. The original fund was set up as a class project, right? So it was basically seeded through this donation. In order to be in the Rebel Venture Fund, you had to be enrolled in the class, and that was originally the way that it was set up. But what pretty quickly we became to realize was that students wanted to participate more than a semester or multiple semesters, and having to enroll in a class and pay for a class wasn't very friendly for that. And so we quickly ditched that effort and moved more towards a student organization that was run by students, and students could participate at any level at any part of campus. And so that became too restrictive for us. We have had students, many of your campuses are maybe older than ours and have relationships with organizations from a recruitment standpoint more sophisticated than ours. We're a university that's only 65 years old. We have about 33,000 students. The vast majority of those are undergrads. We do have PhD programs, but not a lot of PhD programs. We are an R1 institution, but we don't have Goldman Sachs and JP Morgan Chase every semester coming to our campus to recruit our students. But we have had students accept positions in those companies because of their experiences through the Rebel Venture Fund. That has been a unique experience on their resume that typically garners lots of questions, and typically it helps them get jobs in those type of organizations. The training is set up by the students. So every group of students are recruited every semester. They start at the beginning of the semester. We have typically between 15 and 35 students in the fund, depending on the time of year or the rotation of graduation or whatever it may be. And then they leverage people in the community to come in and help do the initial training for the new students that they bring into the program every semester. I'm looking at the clock. I think I have five-ish minutes, so I'm pretty close to that number. So I'll pause here, take some questions, and then we'll proceed. Jeff.
Awesome. Well, Lee, thanks. I think what I'll do is we'll let each of our panelists describe what they do, and then we'll have more group conversation towards the end.
Sounds good.
Once again, I do encourage our audience to submit any questions using the chat function. And Leith, if you get any questions, maybe you could put your URL in the chat, things like that, or answer any other questions.
Will do. Thanks, Jeff.
But with that, I'm going to introduce our next panelist, someone I met, goodness, almost 25 years ago.
Oh my God.
Elaine Hagen's been running amazing programs at UCLA, and she's got more than one venture fund. So I'll let her describe what's going on at UCLA.
Thanks, Jeff. I'm going to share a little bit about the history of some of these funds got started at universities in general first, and then tell you about some of our different types of funds. I'm also going to put a plug in. Monica Dean's on the call, and she and I and Elisa Grossman are doing a panel on this topic in October at the conference for those of you that want to dig a little deeper. But it's Stanford University in the 1980s, where I worked at one point, and I don't know if any of our Stanford colleagues are here. There was a new dean in the School of Engineering, and he took a look and realized that they were relatively under-endowed in terms of endowed chairs in the School of Engineering, and he wanted to do something about that. And he approached three of the seminal venture capitalists at that time and said, I'd like you to endow some chairs, but moreover, if we can figure this out, I'd like you to take the money that you're donating and invest it in your venture funds and manage it, because I think you can generate some excess returns that would benefit the university. They had to convince the board of trustees that that was a good thing to do. This band of three quickly turned into seven, and they launched their first Stanford Engineering Venture Fund, which funded 7 endowed chairs initially. They, over a period of almost a decade, returned 30% a year. And then the original investors turned it over to a next generation of venture capitalists who continued and even had higher returns, but they funded those chairs, which the dean had to backstop the cash until the liquidity occurred from the venture funds. They also contributed to a number of graduate fellowships. It was some of the seed funding for the Stanford Technology Venture Program, and it caused a lot of other people to say, hey, maybe we have some alums who are venture capitalists who might be interested in supporting something like this as well. We had an initial conversation about it here in the early 1990s, and our board felt like our endowment was a little too small to lock up a significant amount of capital and venture funds at the time. We had launched something called the Student Investment Fund, which, much like what Leith talked about, was a way for our students to get some experience they couldn't get in the classroom, but more in traditional investment management. It started with $250,000 and ultimately wasn't large enough to make venture type investments, but it seeded our relationship with the people who manage assets in the university and developed, they developed confidence in us that we were trusted partners and that students could indeed do these types of things without causing any liabilities for the university. The Student Investment Fund now is an 18-month experience, receives course credit. It is $4 million now and has, we use the distributions from that fund to support fellowships for other students in the university. Mid-1990s, Internet 1.0 comes along. Everybody is hot on venture funds again, and every investment bank service provider in Silicon Valley, private high school, was launching what were known as co-investment funds to co-invest alongside venture capital firms or the entrepreneurs they knew in deals. And that's when we kind of got started in this space. And our initial fund was based on donor engagement among some of the alumni of our Venture Fellows program, where we've placed people in venture capital for about 40 years. And we thought, here's a group of people that we can engage and get them to know each other and invest with each other so they can do transactions together. So we were really coming at it from that point. We tried on the first fund to engage students, and I swear our first half a dozen investments, it was always, I get a phone call December 23rd, hey, we got a deal, there's a tiny bit of room left, are you guys in? And of course the students were on winter break. So we have a couple of funds that were donor invested, one that we were co-investing, and much like the Stanford group, we're piggybacking on the due diligence of the venture firm. So that was done for us in generating returns. And then we had one donor say, hey, I want to invest in all your student entrepreneurs that are coming out of here. So why don't you take that same group you're working with and let invest in the students, but also let, he really was focused on letting the students look at these investments as well. So we've done some of that. We later had an impact investing fund created, and much like with Leith's fund, there's just so few jobs in impact investing right now. We really wanted to give the students some experiential learning in that space, and we use a group of faculty advisors to work with that fund. There's a course alongside it. The students typically go through the course in the first year and then are allowed to invest assets in the second year. We're probably going to convert that into a capstone experience. One other thing that was noted in the email that went out, we have something called the UCLA Venture Fund. That was an alumni-led effort, which was a combination of cash donations, and sometimes people would donate their founders' shares or make a pledge to donate them upon liquidity as a way to provide resources to UCLA. We've had a fund that supported our College of Letters and Sciences and one in athletics. If you have something that is exclusively alumni-led, there are a number of admonitions and advice we can give you at that front. My notes were exactly the same as Leith's. My first recommendation is know why you're doing this. Are you seeking excess returns, or are you seeking an educational experience? What are you allowed to do? Who's going to manage your assets? Who's the fiduciary? It does take a lot of time to staff these things. Keeping your students as excited about portfolio monitoring and reporting as they are about making new investments requires a lot of cheerleading on your behalf. But that's an overview of where we're at, and I'll hand it back to Jeff.
Thanks, Elaine. There's a lot there. I've got a bunch of questions, but I'll hold on to them for now. Next up, we have Eric Gordon, who is the faculty managing director of the Wolverine Venture Fund and Zell Early Stage Fund at the University of Michigan Ross School of Business. I remember when the Wolverine Fund launched more than 20 years ago, it made a lot of news as one of the first of these. And so we'll let Eric tell us how that's going and other similar programs. So over to you, Eric.
Thank you. You know, we're one of those universities where if we burp, we make a lot of noise. We are a big noisy place. So I have some slides. Hopefully they're showing up for you. So I'm going to talk about 5 of our funds. We've been at it a long time, and we're a really big university. We're big land grant university. So we have a lot. I'm just going to talk about 5 core funds that invest in early stage companies, and they differ in the student profiles and in their investment objectives. University has pools of money for other university-related early-stage companies, for things coming out of our own laboratories, for our own student entrepreneurs. Lots of pots of money. It almost gets confusing, but I'm going to talk about some of our core stuff. So this is the Wolverine Venture Fund. This is where we started. It's a VC fund. It's for MBA students and for doctoral students across campus. So we have PhD students from engineering, medicinal chemistry, the pharmacy school, the public health school, who are interested maybe in not going on the bench, and who also bring us a lot of technical expertise that we use in due diligence. A number of years ago, I wasn't here for the beginning of Wolverine. I inherited it from some very capable hands, including somebody who went on to be a partner in Michigan's most successful for real venture capital fund. A number of years ago, I was asked if we could do this for undergrads. There was a lot of skepticism around the business school about whether undergrads could actually make these kinds of decisions, but we started another VC fund, and it's for undergraduate business students. It's now in its 8th year, and in fact, it's worked quite well. They absolutely are able to do this. We also have a student-run. These are all student-run funds. We have an early stage commercialization fund where, unlike the first 2 funds, my first 2 funds, our goal is not necessarily to invest in things. We invest in the U.S. We do not invest outside the U.S., but we have investments in Los Angeles, in Washington State, a bunch in other parts of California. We have them all over, and a couple of them in Michigan. The third fund here, this early stage commercialization fund, is much more focused. This is amounts of money for companies that are entrepreneurs, often professors who've done a startup based on lab work, often with one of their doctoral students. We have a student-run social venture fund, which is just what you would think, a blended return kind of thing. And then our newest fund is a student founders fund, which funds students who have started companies while they're students and are graduating and are trying to decide, do I go work for Goldman or McKinsey or Amazon, or can I work for another year on my fund? So this fund invests in students with those kinds of companies. Really high risk, because at the end of a year or two, maybe they just can't resist getting a steady paycheck. But this gives them some more. Runway. We have some other student-led funds that are not early stage funds. Use a similar model to ours, but are not for us. Our student-led funds are on a donor or budget model, which is to say, we do not get into conflicts of interest of that you sometimes get into, where you're sharing money with a donor, or you're splitting proceeds, or complicated co-investing deals. Those can be done, but they're a little more complicated than we wanted to get into. We just wanted to duck. I'm sorry? Okay, yeah, we just wanted to duck all of that stuff. Everything's supervised by a faculty member or an executive in residence. Our funds, with the exception of the last one, are courses. They're courses for credit. We assume that our students have very little understanding of early stage investing, and that we need to teach them that. So the front end of the year is boot camps and heavy duty teaching. Our students are on a fund for 2 years. The MBA students for both of their years, the undergraduate fund for junior and senior years. In their first year, they're the newbies. They're learning from me. They're learning from the second years. In the second years, they become the fund leaders. What is our goal? Because we've been around longer, we're probably a little bigger than many of you. We started with $2 million. We are now we're sitting on about $7 million in cash, and on paper about $7 million in unrealized gains, underline unrealized. So I think of us as having $7 million and hopes and dreams. So we're really focused on the student outcomes. What are we interested in? We're trying to get them to understand to do unstructured initiative taking. Our business schools curriculum tends to teach them how to make decisions in highly structured situations. They get a case and everything's in the exhibits, and we lay it out for them. This is their workshop. This is their training to do. What are the questions? Instead of we asking them the questions, they have to come up with the questions. Analysis with weak and conflicting signals, sophisticated approaches to risk. So at some point, they all read some kind of mean variance idea about risk. And we have to get them to unlearn that, try to get them a little bit more sophisticated approach to risk. We don't have any means. We have lots of variance, but we don't have any means. Decision-making under high uncertainty. Especially for our undergraduate students. They're not used to being wrong, or they're not used to being told they're wrong. They're not used to feeling anything but super confident. So we put them in a situation where they're not confident. Anybody who's confident is out of their mind. I mean, if you're confident about your VC decisions, you're a scary person. So we try to get them comfortable with that, teach them some techniques for that. And then, standard things like get them to do hands-on looks at business models, startup financial models, and heavy duty technology to market and adoption models. We've all lived through this is a great idea. This is a fabulous technology. In theory, it's a great market, but the adoption cycle is too long or the acquisition cost is too long. A lot of the things that they don't get in their, their usual marketing classes, and then sort of miscellaneous entrepreneurship success factors. For me, the biggest thing is I want to change or add to the way they're thinking like an early stage investor, not thinking like a McKinsey consultant or somebody who's going to go to Bank of America and be an equity analyst, but think like an early stage investor, and then think like an entrepreneur, because you all know, there are people on each side of the table. And if you're going to be a successful early stage investor, you need to understand the entrepreneurs. If you're going to be an entrepreneur that needs outside investing, you need to understand them. We are also interested in top tier risk adjusted returns, not because it makes a difference to the university. So again, we're a big university. We are part of the endowment. Our funds, the custodian agent is, and administration is through the endowment, but the endowment is a little under $17 billion. So our $14 million doesn't matter. It keeps us evergreen, but it's also a reality check. So, if you've ever suffered through one of these assessment of learning exercises when the accreditors show up too often, sort of what part of our assessment of learning is, not how can they do on a quiz or on some kind of exam, not what kind of PowerPoints they throw up in their due diligence, but how are we doing on the returns? Now, here's the tricky thing. The students graduate and we find out 5 years later. But as a program, it's a good assessment of learning. It's not an assessment of learning of my students who are here today. I won't know. I have an idea because I'm very involved. I'm in all of the meetings. I listen to their due diligence discussions. I make suggestions. I give them hip checks. But for program assessment, does the family of funds make sense in terms of anything you can assess as an outcome? Well, yeah, we went from 2 million to at least 7 and maybe 14. So that's some kind of reality check as opposed to just, well, Gordon's doing this and boy, he thinks it's good. Okay, I don't know where I'm on time, but I'm done.
Awesome. Well, thank you, Eric. So I'm going to play a little bit of devil's advocate and ask our 3 panelists to each chime in or respond as they wish, or as I call on them. I have considered for more than 20 years in the different roles I've had at 2 different universities, whether we should create a fund like this. It started around the time the Wolverine Fund got started, and every alum, every student said, hey, we should do this. So one of the biggest concerns I've had, and some of you touched on this, is how much time does it take to run this? Whether you're a faculty member or a staff member, somebody's got to run the show. And, whether it's part of a class you teach or whether you're the one signing the fiduciary documents and all that. Like if you're giving advice to somebody who's considering launching one of these funds, how much time should they allocate? How should they expect to do this?
So, Jeff, I think you and I have talked about this over the years, but I'll clue some folks in on this because this is an important question for me. We have a new dean who started like a month ago, and one of the questions the dean has asked me is, "Wow, how do you justify this? This is a really expensive proposition for the school because our funds are small. You can't put. I won't say you can't. Our way of doing it is we don't put 50 people into the fund. This is a small, like seminary thing, handcrafted thing. So her question, and I'm faculty, so I'm burning through my course credits doing this. And her question is, well, look, you should be in a room with 64 students instead of a room half that size. And her second question is, we can't add extra sections of this. So is this something where, is this an elitist thing where 42 students get to do it and we have 200 or 128 students who want to do it and we can't add an extra section? So I would say, Jeff, it seems like it's fun and games, and it's fun and games for me. But these are the kinds of questions deans ask you, and not without reason.
All right, thanks, Eric. And I'll let Elaine and Leith kind of chime in on that before I go back to it.
Yeah, obviously there's the amount of time you have for the class, but we have 2 staff in the Price Center who work with our core investment funds. We're actually advisory to another unit that has the impact fund, because if you don't know how to run these things, you can create a lot of headaches for yourself and other people on the campus. We try to tell people that they should expect from start to finish a minimum of a month for a due diligence process, but our foundation asks that we allow for a week for signatures. Everything's on DocuSign or another platform now, so that's gotten a lot easier. We are not allowed to sign. The CFO of the foundation has to sign on behalf of the university. We also had to make sure, the CIO of our investment company said, I don't want my compensation to be impacted by what your students do in this fund. So those are specifically excluded from how he is measured on his performance. But it's not uncommon on a follow-on financing, which you may not have more capital to put in, that you still need to get signatures because they need a majority of the shareholders. And ultimately, at the end of the day, you're usually so small that they don't really need you, but they want everybody to try to sign. And sometimes we'll say, we get it 3 o'clock on Friday, we need this signed by Monday morning, and we're constantly trying to talk with staff to see, are the people on the other side of campus even around this week? I mean, it's so much easier now that we can do digital signatures, but in the old days, it could be a challenge.
Well, and Elaine, just before Leith chimes in, so you run a center, you have a lot of other activities. What percentage of your time is devoted to managing the student funds, these various student-run venture funds?
I sit in on the meetings with the investment committee for the impact fund, which we do on a quarterly basis with them reporting out. But the transactions, it might be a dozen types of different transactions a year, but each fund is typically making, I would say, 2 to 3 investments at the most in a given year. So that fire drill happens on an occasional basis. Our student investment fund meets with a group of and going back to what Eric was talking about, we have 4 people who are instructors of record who have decades of experience in investment management. They meet weekly with the students, and they have to do phone calls during the summer as well, because the markets don't go away in the summer or over winter break.
Yeah, okay, so you have a set of things you need to do, but there's also a big team of experts who spend a lot of time on this too. So Leith, how much of your time do you spend on this?
Yeah, good question. I think I think it could be as sophisticated as you want it to be, right? I think that's the truth. I think, from what Elaine and Eric are talking about, I mean, they're managing multiple funds with multiple initiatives with different constituents involved. The way we run ours is I mean, honestly, it's much more hands-off. It's almost like it's a program that I run inside the center. I hold a bi-weekly meeting with the directors of the fund who are students, and that's at their request. Sometimes the directors want to meet once a week for 45 minutes. Sometimes they want to meet every 2 weeks for 45 minutes. And so when I say I'm hands-off, I mean, if you get the right core of students, right? I mean, they're type A's, they're A's performers, and the B's and C's don't want to participate, right? Because they meet and they work hard and they do those things, and they're not getting course credit, right? And so the ones that don't want to participate bail out after a few weeks. And then your core of 15 or 20 or 30, those are the ones that move it forward. So, what often happens is if they have a deal they really like, then they'll call me up and say, hey, can we meet? We want to talk about this deal. We finished our due diligence report. What are we missing? And because they don't want to send it to the board unless they know the questions are going to get back, right? And so we go through the process of, okay, these are the things you're missing. So I would say I probably spend an hour a week on that, and that's an average. Some weeks more, some weeks less. But as
are you the signatory, or is there somebody else in the university that has a fiduciary role?
Yeah, so the guy that runs our Office of Economic Development actually is also the executive director of our outside foundation. So he's also an IP attorney. And so, you know, our legal department is comfortable with him. You know, listen, these are simple convertible notes that we never lead a deal. We follow a deal. Someone else is providing the lead. They've already negotiated the term sheet. And so we're basically saying, okay, are we willing to accept the existing term sheet or not? And oftentimes, because we're a university, we're not going to negotiate some of these terms. And so he'll read the contract himself. I'll read it, and he'll sign it as the executive director of the Research Foundation.
All right, I've dug on that point a lot. I appreciate all of you chiming in. Like, I just have talked to people over the years at different universities who have told me it was a lot more work than they expected. Some of you touched on how you need to sign something, you need to chase down signatures, and it doesn't fit an academic calendar. So that's just something to consider. We've got some other questions coming through in the chat. I encourage our panelists to jump in at any point if they want to either answer via chat, or you can just answer verbally if you want. I'll pull one of them, which is around, I think it was Dave who asked metrics to measure the educational impact. You know, Eric mentioned how financial impact, financial performance is a time lagged indicator. What other metrics do you guys have around whether students are learning or how much they might be learning?
So I'll jump in first because I think mine's probably the simplest answer. Because ours is not in the context of a class, we're not necessarily measuring metrics in terms of learned outcomes, right? I would say that we're more of a student org in terms of the way the organization itself is run. And so because of that, we don't have to necessarily measure those things, and students participate based on whether or not they think there's value in it for them, right, in the participation. In terms of the metrics, the other metrics that he mentions in terms of, you know, maybe, you know, metrics in terms of ROI and things like that, we track that. They provide those updates on a regular basis on the board meeting. I agree with Eric's assessment. Hopes and dreams are what the perceived value of the fund is worth, but until there's cash in the bank, it's irrelevant what those things say they're worth. I will tell you, Jeff, because I have a feeling this is one of your concerns. Every year I have a go around with our research foundation about what the value of those investments are, right? Every year, because the auditor comes in and they say, okay, what are these things worth? And I say they're worth the original investment. And they say, well, how do we know that? And I said, well, because there's been no liquidity event that's changed the value of that investment. Well, this company looks like it's dramatically bigger than it should be, than that original investment. So should we make them sign a document that says it's worth so much now as opposed to when we made the investment? And so I always have to push back on that and say, look, it's worth nothing because it could disappear tomorrow and be worth zero, right? And so there are some administrative things that you have to deal with because of the lack of experience of some of the people that are involved through the auditing process and others. But with some sophisticated arguments, you can usually push back on those third parties who may ask those kind of questions.
Leith, you need a new auditor. I'm concerned for you. We have to report on a quarterly basis, and if there's been and whenever there's a step up, we let them know. We also let them know if we're writing it off. We're fortunate to be in a situation with an MBA program where students are hopefully in a position to find some jobs in the alternative investment community. Sometimes it's not right away. Sometimes it's not exactly what they wanted. We're also finding a lot of them become executives in growing companies, and having a better understanding of the venture process is very important as they go to raise money themselves in the future. And we see a dramatic change in performance and behaviors and knowledge from start to finish, particularly in the 18-month program. We do annual reports as well that we share with the donors and other interested parties. So that's another tool you can use. Just real quick, someone else asked in the chat, how do you deal with all your students that are launching ventures, much like the group that's in Eric's last fund? And we are all in this position. We cannot be the venture capital fund for every single student who starts a business or every alum out of our university. And so, managing those expectations is really important as well. How disappointed is someone going to be if you opt not to invest in someone affiliated with the university? And so think about what other resources you have in terms of consultants or interns or other things you could do, because you can get a backlash sometimes from the people you don't invest in.
So one thing we do in term, as opposed to 5 years later when we see the return, is every student will be on a due diligence team and do 2 or 3 due diligences in the course of a year. And you can evaluate those on the spot. I mean, you know the difference between a thorough one, and you can grade those. Not that you can guess whether the particular company is right to invest in, whether you're going to make a type 1 or type 2 error, but do they understand the market? Do they understand product market fit? Do they understand competition? Do they get the revenue model thing right? Have they sussed out management? Do they understand the structure of the cap table? Do they understand the structure of the preferences? So we do have some stuff where ours it's a very practicum kind of thing, but we do have episodes of where we can evaluate it and assign a grade and give very specific feedback.
Excellent. So, Eric, I got another question for you, and or maybe for anyone else too. You touched on the fact that one of your predecessors in this role, who I'll name as Tim Peterson, he helped create the Wolverine Venture Fund.
Yeah.
And because there were some really good returns in those early years, it became more attractive for him to work as a real venture capitalist than a state university employee. And in these roles, right, if any of these funds show real returns, like we're all kind of a mix of educators, maybe educators first, but if we show any promise of being good at investing, it creates some conflicts of interest. And some of you have touched on other conflicts of interest already. So I just wonder if you want to comment on that, or anybody else. Like, how do you manage these conflicts between learning, experience, real money being traded, all that kind of stuff?
I think you want to be very, very careful, because whatever university you're in, you're high profile to somebody. There is a local reporter or a local blogger or somebody who has a bone to pick with your university, which could be the reporter, or it could be anybody else these days, who is looking from the outside and looking at everything in the worst possible way. So I think you just need to be really sensitive to that. For example, what if an alum has started a company? It's their second company. Their first company went to the moon. It was great. They will bring you in under, early, seed, very nice valuation. And you're thinking, if you're like me, you're thinking, wow, yeah, yes, tuck this into the portfolio. What you're not thinking is that the reporter is going to say influential alum, especially if it's a donor, students invested in his company. Isn't that terrible? So you can't handcuff yourself and do nothing, but things that strike me as being wonderful can be cast as being terrible. And if there are any of you who are new to the university game, and everybody here who's been at a university 24 months knows that, but if you're new to the university game, believe it or not, there are people who really resent you and will do anything they can to embarrass you. And the one thing you don't want to be is a small program in a university that causes embarrassment. If you're the medical school and you're bringing in hundreds of millions of dollars of overhead from federal grant money and you stub your toe, they look the other way because but if you're something little like I am, at best in my dreams, $14 million, if I embarrass the university, we're gone, we'll be in our last year.
Thanks for sharing that. So Elaine or Leith, have you guys run into any either major issues or potential issues around PR, conflicts of interest, things like that?
Yeah, so we actually have a line in our charter that says there may be a conflict of interest in every investment that we do, because the likelihood is you're going to source them from someone in your ecosystem. So we just state it. And so just like any conflict of interest, we believe as long as you're transparent about it and you disclose it, then the advisory committee can decide what they want to do about it. But we bring it forward in every instance. We also tell the faculty and staff, you can't invest in a venture of any current student or in a program that you can't have a company where you're investing university dollars and you're investing at the same time and you're becoming better off through the university investment. So you need to be careful with your personal investment portfolio as well. We had one investment where they were working on something that was related to creating jobs for an immigrant population. And there was a period of time where the government clamped down on visas. And so the market went away. So they walked away from the business and kind of put it on pause to do other things in their career because they needed to make a living as well. But there were some unsophisticated investors in the deal who wanted to file a lawsuit. We just declined to be. That's the risk you take. So things like that can happen.
And let me really quick, I will say that, our ecosystem, even though all of our deals are not so sourced locally, to Elaine's point, it's not uncommon to have a source of deals be a board member or an angel group that has a close affiliation. We manage those on a case-by-case basis. So for example, if we have a board member who is already invested in a deal, he doesn't participate in the board meeting, he doesn't participate in the due diligence, and he can't vote on the deal, right? And so, we do our best to Eric's point to try to manage those conflicts, but I'm also convinced that if someone has an axe to grind, they'll figure out a way to grind it, right?
So one thing I just follow up with it, get everybody on your campus educated. So my new dean has an entrepreneurship background, so she's okay. My prior new dean, the previous new dean, knew nothing about this. We have a new president who starts in 2 weeks, who knows nothing about entrepreneurship. You have to walk them through what Elaine and Leith just said, which is in the real world of early stage investing, it's all buddies. I did that before we went into the University of Michigan, and I would get a call from somebody who said, we're looking at this cloud deal. We're thinking of leading it. And, am I in it because of my friend? Yeah, I hadn't even heard of it. So getting people to understand how these things work and frame it in terms of, look, we're trying to give the students a realistic experience. I want my students to go out and be able to go hit the ground running at a venture capital fund. So let's keep it realistic. I guess, I got into a little trouble with the prior dean, and it was my fault because I didn't sit down with him and explain to him how our world works.
Deans often need a lot of extra education. I better be careful saying this on recording, but so we've got a little more time left. There's a question in the chat from Liz Leahy around how do you deal with portfolio tracking, management, exit? I think Elaine touched on this earlier, where students often think the job is all about picking companies, but there's a lot more to being a venture capitalist. So how do you guys kind of manage the whole life cycle of a venture investment when you might only have a short amount of time with students, or they are only interested in one piece of it?
Yeah, let me say that everyone wants to do the deal. No one wants to do the follow-up. No one wants to do attend the board meetings in an advisory or an observation role, right? One of the things that we've attempted to do is we've kind of built an alumni of the Rebel Venture Fund, and so they get regular updates and actually do attend some of the meetings on occasion as well, and they'll have an alumni event every year. So the idea there is hopefully if you participated in RVF 4 or 5 years ago, you still have some connection and idea on whether or not the deal you invested in actually had a meaningful exit, right? And so, but everyone wants to write the check, right? Everyone's excited about writing the check. We made an investment, but like, I'll give you a perfect example. There was a deal they were looking at just the other day that they ultimately decided not to make a recommendation to invest. And I made the comment in one of their meetings, that's probably a lesson learned more valuable than any check they would have ever written, right? And so that longevity of the deal is sometimes hard to close those loops, but that's one way we've tried to do it at least.
Yeah.
So one of the things we do is when the newbies come in, their first project is they're each assigned a portfolio company and they present an update to the fund as a whole. That's how, every fall we get an update on every company, and they become the lead expert on that company, so that if any time in the 2 years there's a follow-on opportunity of a follow-on investor, they're going to lead that due diligence. So they have every motivation to be up to speed. It's their first presentation to their colleagues on the fund, and they want it to be good, and it usually is. It usually is pretty good.
Awesome. I know I like to joke with our students who are interested in venture capital that they don't think about where does the money come from, what happens after the deal's done. I ask them, where do you think venture capitalists come from? Are they just spawned forth from the earth with a pile of money and a Patagonia vest? But yeah, there's a lot more to the business. So we only have a few minutes.
We actually do a lot up front, like in the teaching part of what do you do when you face a down round? What do you do when somebody hasn't hit a milestone? We actually kind of build in that a lot of the job and a lot of the excitement is in getting your portfolio company from the check to the exit.
Excellent. So you guys are value-added investors.
Well, in our own minds.
Awesome. All right. So in our last few minutes, I'll ask each of our panelists, I'll give you a chance to make some kind of closing comments, and you can add whatever you'd like. I'll prompt by saying, is there any lesson learned, like a mistake or problem along the way, or a landmine that you would advise others to avoid that maybe we haven't talked about, or any particular like great benefit or success story from what you've done? You can pick one or either or both of those, something really good, something really bad. Last pieces of advice, and I'll let Elaine go first.
Yeah, you're never going to know what your grand slam is going to be. I'll say that out of the gate. The world changes. So, but one thing we didn't touch on real quick that I want, think about whether you want, if you have a donor approaching you to do this, whether you want to take all the capital all at once or draw it down in capital calls, because if you get it all at once, you should think about how you want to invest the capital that's not invested in portfolio companies. And you probably, like this year, would not want to have it in the endowment in the market, but your investment managers will have some cash equivalents that can boost the returns. If you just don't want that uninvested capital sitting there doing nothing. So
Thanks, Elaine. And Eric, we'll let you go next, and then we'll finish off with Leith.
A caution: be careful about advisory boards. On one of the funds I took over, not Wolverine, one of the other ones, we had to disband the advisory board because the advisory board was pretty heavy-handed. And if the students didn't take their advice, if the students exercised their own judgment, there was some real leaning on by the advisory board. It was difficult for the students to handle. advisory board can also lead to conflicts of interest. So I disbanded the advisory board, and the fund recovered and did well. So be really thoughtful about the advisory board, because when people give advice, they like it to be followed.
Yeah, that's a great point, Eric. I think one of the things that I've noticed is that if I put 10 investors in a room, 3 of them think it's $1 billion idea, 3 think they won't make it till next week, and 3 or 4 are like, maybe it's a lifestyle business, right? And so my point is, we like to think that it's a prescribed success analysis. The reality is it's a little more hunch and a little more of this and that and whatever. So I'm not saying there's not sophistication. I'm saying there's almost never agreement. Let's put it that way. And the other thing I would say is that when you have a fully student-led organization, not just a fund, but an organization in general, I will tell you the pandemic was rough on our student funds. And the reason it is because they didn't meet in person. And because they didn't meet in person, they didn't get that energy of working together and the social aspects of that. And so while performance of the fund is important, the experiences are also important at an even more basic level. The interaction of the students and understanding how to work with different forms of leadership, different levels of experience, freshmen and law school students on the same group. You've got these we have these interesting dynamics. And so just be sure that your organization has a good culture. And as a result of that, the students will have positive experiences that will benefit them, irrespective of some of the things that we specifically analyze.
Well, I want to thank all of our panelists. We really appreciate this expertise from Elaine and Eric and Leith. I can't say that I'm 100% convinced that I should do one of these at Georgetown, but I will confess that there are students and alumni at my school who are pushing for this, so I may be pulled along. And I'll also add another plug for what Elaine mentioned. If you learned some things today and enjoyed this conversation, then we're going to have a workshop at the conference in Vegas in just a few weeks. So I think Elaine and Monica Dean from the University of Southern California are going to be on a panel there sharing even more. So there's more and more chances to continue learning from one another. And again, a plug for the conference. I've got my poker chip here with GCEC logo on it. I look forward to seeing lots and lots of you in Las Vegas. And we'll see you. Our next webinar will be in January. So thanks to our panelists, thanks to Nadine for putting this all together, and we'll keep on doing great work.
Thanks, everybody.